Well, good afternoon, friends, and very warm welcome to this second session of our series of webinars on SIF. So friends, if you recollect, I think most of you would have been there in part one of our series on this SIF, wherein Mr. Jatinder Pal Singh was the CEO of ITI Mutual Fund. He was kind enough to come and take a session on the basics of SIF, and then he also delved into what is the structure, who can be the proposed clients, and so on and so forth. And it was a very well appreciated and very informative session, I would say. So continuing thereon, today, friends, we have with us Mr. Rajesh Bhatia. He is the Chief Investment Officer of ITI Mutual Fund. And allow me to introduce Mr. Bhatia to the audience. Mr. Bhatia is a seasoned investment professional. He's having more than 30 years of experience in Indian equities, and more than 10 plus years of experience in alternative investments, which is very, kind of a very niche category. So he has also held leadership roles, including the chief investment officer at Simto Investments, which is a subsidiary of Tata Investments. So he's also co-founder and former CIO at Heritage India Advisors, wherein he has been advising a New York-based long-short equity fund, recognized among the top performers in India. He previously led the PMS division at Reliance Capital Asset Management, where he established the business in 2004. So he holds a degree in commerce from HR College and is an ACMA and CFA charter holder. So friends, here we have with us Mr. Rajesh Bhatia today, this afternoon, to speak about, more about the SIS and its conundrum, and then what it is, how we can, as a financial planners, look to this product and advising and guiding our clients. So a very warm welcome to you, Rajesh ji, on behalf of FPSB India and on behalf of our fraternity of financial planners today. So over to you, sir.
Thank you. I hope you can hear me. I'm audible.
Yes, loud and clear, sir. Yes.
Yeah, excellent. Thank you so much. So, hello everyone. Thank you for joining us on this call today and giving us this opportunity to talk to you about SIF, which I think is a very apt product for the times that we are in. So it's very I think it is a foresight of SEBI to introduce a product like this and democratize a product like this for the Indian markets. Because the SIF or long short equity or long short products, alternate products are a $5 trillion market globally. 5 trillion, that's a very, very large market. And rarely you will see any financial institution, family office, or pension fund, universities, endowments, which are not having an allocation to a long short equity fund or alternate asset class hedge funds globally. So that opportunity is now available to retail investors who can put in at least 10 lakh rupees in a particular SIF for the Indian community. So I think it's really apt that an SIF like a product has been introduced in India. Now, I think before I begin, I must tell you that SIF is like an umbrella. Rashmi, I don't know if she's there, but I hope we can put up our presentation as well.
Yeah,
Rashmi, I
I'll do
hope,
that.
please. So as she's bringing that presentation online, what I want to tell you is that SIF is a umbrella. Just like as you have mutual fund as an umbrella, SIF is an umbrella. Under that umbrella, let us say in the mutual fund, you have equity funds, right? Large capitalization fund, small capitalization funds, mid cap, flexi cap. These are equity funds. Then you have fixed income funds, overnight fund, right? Liquid fund, right? Duration funds, so on and so forth. Dynamic funds, so on and so forth. So those are fixed income funds. And then you have hybrid funds, balanced advantage fund, equity saving funds, so on and so forth. So just like mutual fund is an umbrella, and under which you have equity funds, fixed income funds, and hybrid funds. Similarly, SIF. Specialized investment funds is an umbrella under which you have equity funds, long short equity. You have fixed income funds, long short fixed income funds, and then you have hybrid funds, right? So again, in SIF, just like a mutual fund, there is an umbrella under which you have these three categories. Why am I making this distinction? Because I think people, because it's such a new product, they are comparing SIFs within each other. So because there have just been such few launches of SIF, people are comparing one SIF with another. That may not be the correct approach. Let us say in the mutual fund, you don't compare small cap fund with liquid funds, do you? You don't. You don't compare a mid cap fund with a balanced advantage fund, right? Because the objectives of those funds are very, very different. You will compare small cap with a small cap fund, a liquid fund with another liquid fund, a balanced advantage fund with another balanced advantage fund. So similarly, I think people are making a error at this moment by comparing different SIFs with different objectives. Broadly speaking, the hybrid SIFs are income generating SIFs, right? So their focus is, generally speaking, to give you arbitrage plus returns. So that is the hybrid category SIF. Then you have fixed income SIF, but there are no fixed income products that have been launched yet. And then you have equity SIFs. In equity SIFs, again, you have all cap equity fund, equity long short fund. Then you have X100 long short equity fund, and then you have sectoral long short equity funds. Again, in this category also, which is the equity SIFs, there are two areas where people are focused. One is the equity long short product, and the second is X100 long short products. So that is what I just want to clarify this. Let me reiterate again. SIF is an umbrella under which you have equity long short products, fixed income products, long short products, and then you have hybrid long short products. These are not comparable because the objectives of each of these is very different. Where is, specifically I want to talk to you about where ITI or Divinity SIF is. For the moment, we have launched only one product, which is an equity long short SIF. So that is really where we are. And I want to tell you a little more about this. I will not get into about hybrid funds or fixed income funds. Those are separate funds. I today only want to talk to you about what is the objective of a Divinity equity long short product. That is where my focus is. Let me kind of tell you what the objective of a long short equity product is. Rashmi, can you move up a few more slides, which means go down? Rashmi? Yeah, go down. I'll tell you, keep going down. Keep going down. Yeah. Please go down. Go more. Yeah. This purpose, this is the one, right? So I want to tell you what the SIF of Divinity is focused on. The SIF of Divinity, which is a long short equity fund, is interested in generating an asymmetric return profile. What is the meaning of that? Now, when you invest in a long only equity fund, let us say it's a small cap, mid cap, or a flexi cap fund, what happens in that kind of a fund? When the market goes up, those funds also go up in the NAV. When the markets go down, those funds NAV also goes down. That is a symmetric return profile, right? That is what today we have. In fact, mutual fund has been so successful and India as a market has been so successful. Let me elaborate on that. India as a market has been so successful. For the last 40-45 years, Indian equity markets have given anywhere between 14 to 15% return per annum, including dividends. It's around there. That's a fantastic rate of compounding, right? For such a long period of time. I can't think of any other market other than India and US, which has given you this kind of consistent returns in the equity market. No wonder mutual fund sahi hai and be in the long only market has worked miracles for people who have invested in India. So, there is a reason why the mutual fund has gone so successful, because we've had a history of 20, 25 years of people who have invested in the mutual fund industry. And, like I pointed out, Indian equity markets have done extremely well. So there's a good reason to be in a long only mutual fund or a long only product. But what also has happened is that India has become dominantly a long only product, right? So even if you look at PMSs, AIFs, and mutual funds, all are in one side of the market, generating a symmetric return profile, which is if the market goes up, their portfolios go up. If the market goes down, their portfolios go down. So a lot of the money is now concentrated there. Now that has become a bit of a challenge. What is the challenge? If you're only invested in long only, and some people have been commenting recently in the last few years, Indian markets are becoming expensive. So then what is happening? Passive money keeps coming into the market and markets kind of keep going up, right? And valuations become expensive. People would argue that mid cap and small caps today are definitely a little more expensive. Large caps, to my mind, is also now cheap. Not only less expensive, it's cheap now. But having said that, mid caps and small caps are a little more expensive. Now, what happens is, let us say if you have a macroeconomic risk like today that we are going through, oil price goes up, which creates a challenge in the market. Because as I think several people have been commenting, and now more recently even the Prime Minister of India, that there are challenging times. So what happens? If the macroeconomic problems come in India, then the market has to come down because the earnings growth trajectory will come down. But what did I tell you? Everybody is in long only. If the market comes down, their portfolios will also come down. So now people are finding, is there another product where if the market comes down, I am protected to some extent because I have all my money in this symmetric return profile. Can I get a product which diversifies my portfolio? I want to keep some money here where in case the market comes down, then I'm able to protect my downside. The answer is a equity long short product like ours. So that generates an asymmetric return profile. I've already told you symmetric return profile. Asymmetric return profile is what you see in front of you. So let us say from Jan 23 to September 24, that is the table in front of you, market went up 42%. The long short strategy went up by about 44%. So they made about, in 18 months, the long short strategy made about 44% return when the market made 42% return. Subsequently, then the market came down. It came down by 14%. That is the index. Mid cap, small cap indexes came down by 20-25% during that period, October 24 to Feb 25. We're all familiar with that. When that happened, the long short strategy, when the market was down 14%, was down 3. So you can see this is an asymmetric return profile. When the market goes up, you participate, but you don't participate as much. I'm not saying capital protection, but there is a bit of a downside protection when the market kind of comes down. What is the cumulative effect of that? The entire curve, it's gone up, it's gone down. What is the cumulative effect of that? That is the table below that you see. The market in that cumulative period from Jan 23 to Feb 25 has gone up 22%, and the long short fund has gone up 40%. It has generated 18 percentage points higher return than the index. That's an alpha of 1800 basis points with much lower risk and much lower volatility. So you can see the need for a product like this when all the money of any portfolio is invested in long only products where there is a symmetric return profile. You now need a product where there is an asymmetric return profile where you can protect your downside. So what happens when you add a product like that to your portfolio? It reduces the risk of your portfolio. It diversifies your portfolio. And it offers a strategy which is not correlated with your core equity portfolio. I am not suggesting that take all your money on long only and put it in long short. No. But I'm just saying that given the conditions that we are in, that it makes sense for you to take some money of your long only and put it now in the long short equity space. What do I mean by the conditions? I've already told you Indian markets are a little more expensive because passivity of the money inflows that are going into the mutual fund market has made mid cap and small cap expensive. Now we are faced with the macroeconomic challenges. I can tell you that I've been in the market for 30 years. Big corrections in the equity markets only happen when there is a macroeconomic imbalance, macroeconomic dislocation. The oil price rise and the Iranian war is one such macroeconomic challenge that we have. If this problem goes away tomorrow, starting tomorrow, sure, then I think we will have equity markets come back again, even though the oil prices will remain higher for some more time. But fortunately, it's a fantastic market. We've had a correction since September 24, October 24. So basically, a long period of time, 18, 19, 20 months have elapsed. And since then, we have not touched a new high, at least as far as Nifty is concerned, right? So we've had a sideways market for a long time. There is good reason then, if the Iran war were to get over tomorrow, that markets kind of go up and, we are all happy. But what if it does not? What if there is a challenge and the war lasts a little longer? Month, 2 months. Worst case, more than 3 months. People are already talking about supply shortages, costs going up, lack of availability of material. That will mean production coming down, etc. And that can mean earnings of companies or profits of companies coming down. And that can mean more challenges for the Indian market. So there is a certain risk in the market that is there, which you need to guard against in case this Iran war kind of elongates. That's why, again, the long short space makes more sense. I will give you another example. Today, we are looking at only India. There is a challenge globally as well. I was fortunately, I'm here talking to companies, right? And I met a manufacturing company, and they were telling me that manufacturing is collapsing in Europe. Fortunately, it's coming to India, which is a great opportunity for India. But you can see there are many challenges, countries like Europe, America. We all know that America has a $39 trillion debt. And they are trying to ensure that the dollar doesn't lose its value. Otherwise, they are in trouble. There's a problem of inflation globally. There's a problem of private credit in the American markets. There's a problem of overproduction in China. There's a problem of geopolitical risk across the world. There are just so many global problems that we are faced with. The fiscal and the, just a little technical, but fiscal and the monetary base of developed world has expanded to an extent that they cannot use that lever anymore. Point I'm making is there are global risks as well. So, and you are faced with an asset market which is expensive. Another reason why you require a long short strategy in your portfolio. Rashmi, can you go to the next slide? Alokchi, I hope I'm clear and you're able to hear me.
Loud and clear, Rajesh ji. Perfectly
Excellent.
fine. Yeah.
Excellent. Great. So, sometimes I wonder, I hope I'm only not talking to
No.
myself.
Yeah. No, perfectly fine. Yeah.
Please
Go ahead.
So you can see, what is this long short strategy for 8 years delivered, right? For 8 years, 9 years. Of course, I've been in the long short business for 19 years now, 18, 19 years. But Lord, what has it delivered over the last 8 or 9 years? So that's the chart in front of you. So as you can see, those circles, right? Those circles are the time the market has kind of corrected quite sharply, right? And in each of those times that you can see, the long short equity fund has been able to protect downside. Again, I'm saying downside and not capital, right? Most conspicuous period of that is the COVID crisis, when actually the top to bottom the market fell 38%. The long short strategy, well, remarkably was up, but that's not the promise of a long short strategy. But That is the evidence of the long short strategy. So as you can see, the long short strategy has been able to protect downside in each of these cases, but it's beating the market as well. So it's beating the index with far lower risk and far lower volatility. That means the product has merit on a standalone basis. It is delivering an equity return, beating the Nifty with much lower risk. Now, I can tell you there are a lot of products, let us say like balance in one day, arbitrage fund, equity savings, right? Long-term debt, right? ETF, Nifty ETF, large cap funds. All of these funds that I mentioned, the long short equity fund has a better risk return profile than all of the funds that I mentioned, right? So why would you invest in an ETF when you have a fund which can beat the market but protect your downside? ETF will move along with the market, right? So you are taking lower risk and yet beating the market. So it's a better product than the ETF as well. So you get the point that there is a value add that the long short equity fund provides. If you'll bear with me, I want to share two investment insights with you. Can you go to the next slide, Rashmi? This gives you some sense of the risk metrics, basically drawing on the point. As you can see, annualized standard deviation is half. You're beating the market with half the risk of a Nifty. Go ahead. Can you go to the next slide, please? Can you go to the next slide, please, Rashmi? Yeah. So I just want to dwell on this aspect of investing, since this is an educational experience. Let me share my investing insight of 30 years, right? If you look at a lot of the serious investors across the globe, the first thing they will tell you is that the secret to compounding over a long term period is never to have permanent loss of capital. I'll repeat this statement. If you talk to and read about the greatest investors in the world, across the world, but particularly in America and Europe, because they have that long history of equity markets, what they will tell you is that the first rule of making sure that your wealth compounds at an attractive rate over the long term is never to lose permanent capital. Everybody has heard of Warren Buffett. Do you know what his first rule of investing is? Rule number 1, don't lose money. Rule number 2, never forget rule number 1. People who have been following Warren Buffett would know he has $400 billion in cash at this moment in a market which is the best market in the world, which is America. So he's keeping all his money in cash and not participating in the best market in the world, which today is America. Look at Amazon, Nvidia, all of these companies, Google, they've done so well. And he's kept all his money in cash. Why? Because he doesn't want to lose money permanently. Investing in a bubble, right? If you lose 50% from the bubble period, what happens is your compounding of 30 years gets damaged. There's a fantastic book written by Mr. Seth Klarman, again, one of the legendary investors in the globe, Margin of Safety. Best book on investing. It's available online. You can't buy a copy because it's no longer available in print. But you can download it, called Margin of Safety. In that book, he says, you can compound something like this, that you can compound for 30 years at, let us say, 15% per annum. And in the 31st year, let's say you invest in Nvidia and lose 50% of your money. Nvidia goes from $5 trillion to $2.5 trillion. Well, it can easily go to $2.5 trillion. It was $2.5 trillion 1 year ago. Your 31 years of compounding becomes from 15% to 7% or 7.5%. You've lost 30 years of good compounding. if you lose money permanently. So the rule in to create wealth over the long term is don't lose money is the first principle, and never forget rule number one. I've given you two portfolios, and in the portfolios you will be able to see one is a rabbit which grows very, very fast, right? But loses money as well. We can see that usually happens in small cap funds. And the second is an agile turtle. I'm not saying he's a slow turtle, he's an agile turtle. He doesn't grow as fast as the portfolio one, but he doesn't lose money. Surprise, surprise, the portfolio 2 is ahead of portfolio 1. This is an investing lesson that I don't think people understand clearly. The secret to long-term compounding. The secret to long-term compounding is downside protection. That's what is the winning by not losing. So that's one investment principle I wanted to talk to you about. If you can go down, Rashmi, I want to talk to you about another investing principle. When I talk to people today, people are of the view equity investing में risk नहीं है. Even if the market goes down today, tomorrow it will bounce back. Look, it bounced back in the COVID period. Look, it bounced back after September 21 when the market fell down. It's bouncing back in April of 26 as well. So there can't be long-term low returns in equity. It is bound to bounce back. You know, we've had a decade of investors or advisors who have not seen a deep bear market. Now, if you look at 94 to 2003 period, entire decade, market gave you zero returns, right? If you look at the period from Jan 28 to 2000, Jan 2000, actually 15 for a long only fund, market gave zero returns. Now imagine if your investor is a 50-year-old, 60-year-old, 70-year-old. Can he afford to have zero return in equity portfolio for 10 years? Chances are that he is not. There are 50-year-olds that I know of who think they will compound at 15% per annum, और मेरे पास 5 करोड़ रुपया है, जब तक मैं 60 years का होऊंगा, which is 10 years from now, right, I will quadruple my money. So मेरा जो 5 करोड़ है वो 20 करोड़ हो जाएगा, and that is enough for me to retire. I'm not expecting 25% per annum. I'm expecting 15% per annum, which is what equity is supposed to give. And more, if 5 crores become 20 crores, I will retire. But what if that 5 crore remains 5 crores? That is a risk that you have to take care of in asset allocation before the event. What is the answer to that? Keep some of your money in a long short equity fund or such a product where if things go bad, your downside is protected, and if things go right, then at least I'm getting an equity kind of a return. So that is a second insight of investing I wanted to share with you, that equity can have long periods of no return or zero return. Please keep that in mind when you're doing an asset allocation framework for your investor. Now, I just want to summarize that we are an equity long short fund. That is what SIF is. We are a long-term equity product. Please do not confuse us with hybrid long short equity funds which have come into the market. Their objective is to generate income. Our objective is to generate capital appreciation. So we are a long-term product. We are an equity linked product. We are not an income product. We are a capital appreciation product, which means we are necessarily a long-term product. So that is the characteristics of what we are doing. And like I said, the equity long short product, what it does is two things. It buys equity stocks and shorts equity stocks. And the second, it manages the exposure of equity as it navigates the cycle. Those are the two things that we do to achieve the objective of an asymmetric return that I spoke to you about. So I just want to stop here, Alokji. I can go on. I just want to make sure that the people who are listening understand what I'm saying, and I'll leave some space for Q&A, and I'll be elaborate on my answers to those questions. Over to you, Alokji.
Perfectly fine, sir. I think the pace is good, and I think the concepts what you have taken, especially about don't lose money and the kind of the buffer or kind of safety features which the portfolios should have. I think that's That's very important and well spelled out also. Maybe if you can also throw some light on, like the audience here is a certified financial planner. So what ways they can, maybe kind of go through some of these SIF products which are available and then kind of sort them out and kind of mix and match them with the client profile, and how they can actually go about guiding their clients to meet their requirements. I mean, not exactly the entire portfolio, but yet some kind of a some kind of an amount which they can allocate to these kind of products also, just to take care of all those uncertainties in the market. So how they can go about s- uh, allocating this product to their clients.
Yeah. So if I were to only see the income funds are a different category, the hybrid funds, and I think my advice would be that please take your time to see how those income funds are doing before you start allocating to them. Uh, some are already showing consistency in their return performance, which is good. But uh, my sense is give it some more time before you do the hybrid categories. And I think also this unfortunately is not a generalized product. What do I mean by that? A large cap fund is a large cap fund is a large cap fund. Whether you're buying a ICICI large cap fund or an SBI large cap fund there's not too much difference in the large cap funds of various firms. But you'd be surprised that long short fund strategies can be very different between one house to the other, even in the same category. Even in the equity long short category, the strategy can be very different. So unfortunately, you will have to spend time understanding how each of them is making money, which will make, which will give you some color. That's why I'm saying in the hybrid space, at least you give it some time, because over time you will recognize who are the more consistent kind of players in that market. As far as equity long short fund is concerned, again, see somebody like a Divinity SIF, we have had a track record of 8 years in the AIF market. So we have not come afresh. We have 8 years of a AIF track record in the long short equity market, which we have demonstrated over a period of time. You saw the chart which we shared with you on that 8 year track record. So we have a long history of that track record, and which is very important for you to understand. Now, as far as allocation is concerned, like I said, you know the risk return characteristic, which is asymmetric return profile. What does that means is you don't have to worry about timing the market. If the market goes down, the product will protect your downside, and if the market will go up, it will participate in the equity markets as well. You have to take the SIF away from your asset allocation call. What I mean by that is you don't have to worry, whether I should put money now or later, just like you do in equity fund or fixed income. When you are adjusting equity fund and fixed income fund, you have to worry about the dynamics, or gold, or so on and so forth. Should I be in gold right now? Should I be in silver right now? Should I be in real estate? Those are allocation calls which are dynamic and which you need to make from time to time. Fortunately, in long short equity fund, you take it out of your asset allocation call. You don't need to be dynamic. You don't need to worry. If the market is down, then I will invest in long only fund. And if the market is up, I will invest in a long short fund. No, you can put that allocation in a long short fund for 5-10 years and leave it alone. Because if the market goes down, the downside protection is taken care of by the fund manager. And if the market goes up, again, that participation is taken care of by the fund manager. So my sense is that, let us say if 100 rupees is there in equity, anywhere between 10 to 20 rupees could be invested in a long short SIF as you move forward. That is the allocation that you need to do. So somebody has a 1 crore portfolio, 10 lakh rupees is the minimum that you need to be in an SIF. So 10 to 20 lakhs can be invested in the long short equity SIF. And fortunately, it's not an asset allocation call. You can keep that over the long term, because the asset allocation call between equity and fixed income is being made by the fund manager itself.
Okay, awesome. Yeah, well understood, Rajesh ji. Uh, Basically, so it's all about, keeping and staying invested, being there, and then managing the downside that the product, the SIF itself is doing, playing that role. I
Correct.
have also got some very nice and interesting questions on the Q&A from the audience. So if
Yeah.
you allow me, maybe I can, just
Please,
put them to you.
please.
So it says, who is the ideal investor profile for SIF? And then will you say that SIFs are suitable across all risk profiles or
Yeah.
mainly for aggressive investors?
No, it's to the contrary. I mean, depends upon who is
Uh,
the investor, but it's to the contrary, more for conservative investors rather than aggressive investors. So that's because you're not even going to be 100% invested in equity. You're going to be less than 100% invested in equity. So that's one. And the down protection, like I said, our, at least as far as divinity SIF is concerned, our idea is that we want to protect the downside and participate in the equity markets. So to that extent,
That's the core.
that's the core.
That's the core of SIF, yes.
Exactly. So basically, that is the objective. Otherwise, if you are getting the same risk return profile as a long only product, then why bother with a long short product, right? If I'm going to go up with the market and go down with the market, then why are you in a long short? You should be in a long only product. So unless the long short product gives you a differentiated return, which is goes up and then protects your downside, there is no need to be in a long short equity product. So that is at least my purpose of the Divinity SIF, and that's why it is a low risk product, right? So that's as far as the context is concerned. Anybody who can invest more than 10 lakh rupees, but has a portfolio of, I would say, at least 50 lakh rupees or 70 lakh rupees, because you should have other asset classes as well. They are the ones who need to be in an SIF.
That's the threshold of 10 lakh rupees. And then
Correct.
perhaps you can do your SIPs with any amount starting from 5,000 onwards. That's what
Absolutely.
Jatinder also told us in the
Correct.
previous session.
Correct.
Yeah.
Correct.
So
Correct.
I have another question from a gentleman who would like to know, where does SIF fit if the client is already invested in PMS and AIF and all that thing? So does it make sense to also have an SIF
So
for such a
PMS,
client?
so PMS, AIF, mutual fund, long only are one category.
Hmm.
The SIF is juxtaposed to another category, right? It is not comparable to the long only, right? So it is basically a lower risk product than PMS, AIF, and mutual fund. So, like I said, because the need for a lower risk product, which still makes you an equity return, that kind of a product need has just gone. So it's not directly comparable with PMS and AIF, which are far more aggressive and riskier products than
Correct.
a long short product.
Correct. I think the entire DNA is totally different, with this
Correct.
product and that product. So it makes a lot
Absolutely.
of sense. Even if they are invested in PMS, AIF, I think it still makes sense, a lot of sense to have, this product as well in their portfolio.
Correct.
And how about taxation, Rajesh ji? I mean, what about capital gains and long term and short term? How does that happen for with
Just like
SIF?
just like the mutual fund, for the
Okay.
equity long short equity, which is what Divinity is in, the long term is 12% plus surcharge, and 20% plus surcharge. So just like a mutual fund is the taxation on the SIF as well for Divinity SIF.
Okay. So that makes it simpler. I
Yeah,
mean, in terms of taxation, I mean, you don't have to really break your head that what
absolutely,
kind of taxation will be there. Yeah.
absolutely, absolutely.
Okay, wonderful. Then I do have an observation from another fellow professional who says that uh, people are more comfortable going for mutual fund rather than the SIF and AIFs and all those things. So which is quite understood actually. I mean, we hardly have much, kind of info or knowledge. Although the product is, and the product is also relatively comparatively new, I would say, the SIFs and
Yeah.
all that. So I think with passage of time, only people will get more info, more knowledge about it, and then they will be more comfortable. What do you say?
Yeah. So I think as history gets developed, see, in the initial period, even mutual funds were viewed with a lot of suspicion. Right? कि म्यूचुअल फंड में जाना चाहिए कि नहीं, I don't know if you, I don't want to take names, but there were earlier mutual funds which didn't do as well. So for even 6-7 years, the mutual fund industry went dead. Right? I'm talking about starting from 1994 to almost 1997, 98. Right? Nobody wanted to even talk about a mutual fund. But then after that, history started getting created in the mutual fund business.
Those were the days.
Yeah. So, so,
Yeah.
so, so, basically, then after history started getting created, people got more and more comfortable. Now, people today they swear by the mutual fund, right? So, I think it's only a matter of transition that as more history gets developed, people will get more comfortable with what to expect from these category of funds.
Yeah, definitely. I mean, and it all helps, these kind of sessions, the kind of
Yeah,
information flows, and the kind of literature which gets kind of info which we get from various sources and channels. I
yeah,
think that will all help.
yeah.
So, I also have another question to you, which says, is there a minimum time frame to stay invested into equity SIFs? Which I think uh, you already said that minimum 5 to 10 years, but then if you would like to throw some light.
So basically, the question you should ask is, how much time should I invest? How long should I invest in an equity fund, right? So let us say if I'm investing in a small cap fund, because that you're already familiar with, you have that answer. How much time should
Yeah.
I give a flexi cap fund? Clearly, nobody will tell you that it should be 3 months. And people are more likely to sell you at least 18 months to 24 months. You know, keep a longer term view, keep a wealth creation view, keep a capital appreciation view for these equity funds. So, as far as divinity is concerned, it's a similar time profile, which is at least 18 months, and look for capital appreciation. See, the value add of a long short fund will be felt over a full cycle. So that's when greater confidence will come in the product.
True, agreed. And also, how do you like we discussed this in the first session also? What kind of benchmarks, or how do you analyze returns or performance of SIF? Is there any benchmark just like a mutual fund for SIFs? Is there any benchmark? How do you perform? Analyze your performance or performance of SIFs?
So typically our benchmark at this moment is Nifty 50. So we are
Okay.
comparing our performance relative to Nifty 50, although probably it should be compared a little more with the hybrid fund. But
Mhm.
we are comparing because we are never going to be invested 100% in the equity fund. But having said that, I think Nifty 50 is the comparison on which we are gauging the asymmetric return profile, which is protecting downside and giving you equity type return and beating the market. That's really what the over a period of time we should beat the Nifty with much lower risk and much lower volatility. I mean over a period of time, not necessarily in short periods, but over a period of time, and that value addition especially will be felt when the markets go down, where the differentiation with the Nifty will kind of expand rather than when the market goes up. Because when the market goes up, you can't be 100% invested. Chances are the market will do a little better than a SIF, but when the market goes down, it compensates. So over a period of time, you'll do as good as the Nifty or better than the Nifty, but with far lower risk and far lower volatility.
Okay, so basically Nifty 50 is your
Yeah,
benchmark for comparing the performance of the
yeah,
product.
yeah.
Okay. We have there is one more query which says that can an SWP be set up, with an SIF? Let's say after 6 months, let's say after 1 year, can an
Yeah,
SWP be set up?
yeah, I would say after a 1 year period, definitely you can put up a
Okay.
but not before a year period, unless some gains have already been made You have to see some kind of buffer on the equity return before you do an SWP.
But is that a limitation from the fund side,
No,
or
no,
is that a,
no.
kind of how we should look at it?
Yeah, it's a suggestion. Right?
Suggestion, yeah.
Yeah, because it's not. And please note, whatever I'm saying is for divinity equity, long short equity
I
fund,
do it.
not necessarily for hybrid
Others.
funds, which are income funds, etc. I'm restricting my comments to divinity long short equity fund, and my suggestion would be this is a capital appreciation fund. So you should do that only after some time has elapsed, and then you can do an SWB. That is at least my suggestion.
Right. Correct. Yeah, but then the fund does allow. I mean, there is no kind of a
Yeah.
limitation which is there. Yeah, the fund
No,
does allow that. You can put
absolutely.
in start with 10 lakh. The SIF start with 10 lakh, and then maybe have some SWP at some point of time. But yes, definitely, since the objective of the fund, the objective of the investment is to be long, so it doesn't really make that kind of a sense to start pulling out your money
Correct.
from there. But
Correct.
okay. Well, I guess thank you so much, sir. At this
Yes.
point of time, we have these questions in our Q&A,
Yeah.
and I don't see any more. But yes, definitely, in case we have some more questions, would that be okay if we can, send them across to you for your inputs and valuable suggestions, and then
More than happy.
yeah.
More than happy. More than welcome. And would be happy to answer any queries that you have.
Well, thank you so much. So, thank you so much, Rajesh ji, and over to you, Rutika, for the closing.
Sure, sir. Thank you. Thank you so much, Rajesh sir, for your valuable perspectives, and thank you, Alok sir, for moderating the session and guiding us for this meaningful discussion. Thank you so much. To all our participants also, thank you so much for finding time from your schedule and showing active interest through your Q&As, also through your questions. It means a lot. We truly appreciate your time and presence. Before you close, just one small announcement. We have our event coming up on 30th of May at Mumbai, which is FPSB India's Global Financial Planning Conclave. So we have our agenda, which is live on our website under the events tab. So I would request professionals, they can go ahead and they can have a look at the agenda, what exactly would be the flow of the event. And the registration for this events are also open, and the early bird discount is valid till 18th of May. 2026, which is upcoming Monday. So, in case if you have not yet registered for the event, I would request you to do it as soon as possible over the weekend. And the ones who have already registered and have received the confirmation, we look forward for your participation, and we look forward to hosting you at Mumbai. And lastly, for those who want to revisit today's session through a recording, or also if they want to share it with their colleague, the webinar would be available on our official YouTube channel very soon for the broader access. And at the same time, for the active CFP professional, the recording would be available on their respective LMS system also on their portal under the Learning Center, so that you can view the webinar and also claim the CPD credits according to you. So that's it from my side. Anything more you want to add, Rajesh sir or Alok sir? Anything else before we close?
Just that, Rutika, we'll be sending a special invite to Rajesh sir also for the event. In case, it suits his calendar, we would definitely want to have him there as a guest, and look forward to seeing you, sir. We'll be sending a small invite to you for the event. In case you are free on May 30th, we look forward to hosting you.
Very kind of you, Alokji. Thank you so much. And I look forward to further engagement with you. Thank you so much.
Thank you, sir. Thank you
Sure.
very much. Thank you.